Many traders got a taste of what a high VIX environment feels like for the first time ever in their trading careers last week. We saw the VIX actually went up to a recent, multi-year high of about 65. The last time we hit a VIX of 65 was back in 2020. And you can see that something must have really spooked the markets in order to get us at the same kind of territory that 2020 breakout got us to. I was browsing back further, and the only other time in history that I could find of a VIX getting up that high was in the global financial crisis, 2008. 2020 almost got as high as 2008. And the recent week, we all kind of witnessed this together. Volatility spiked to near 2008 levels and then proceeded to crash back down. And in today's video, I want to show you about something that I found that I thought was very, very interesting that the commitment of traders data showed us in this latest filing. I was just taking a look at this, and I'll pull it up for us here together. So the commitment of traders data for newer viewers who may have been, maybe blindsided by this crazy week. Many of you guys, let me know, was this your first time ever seeing the VIX move like this? Some of you guys might have been trading around 2020, but if you were not, then this was a eye opener for you for what markets can do. Even me, who I've traded through, multiple spikes in the VIX, volatility going crazy like this always catches us by surprise, especially when we're used to very low VIX numbers. I mean, getting used to 12, 13 VIX levels, the market's just not moving that much. Whether you're trading gold, indices, everything's kind of chill out. And then, it's a big deal if the NASDAQ moves 1% a day. Then you go look at what we've been seeing recently, and it's like 1% is nothing. This up move was 3.8, and then this down move, which seems, went up by 3% almost, and then down to -1. You can see the volatility is much higher than when we go back and we look over here, and you can see like average days are like 0.4%, and a down day is 1% down, so on and so forth. But I wanted to show you guys something that I found interesting in the commitment of traders data, which if you're not familiar with the commitment of traders data, it is a weekly filing that shows us what institutional money is buying or selling each week. And I track this every week myself. I think it's very useful to have, and that is why it is on the Edge Finder Pro, our software tool that I'll tell you more about in a second. But under the commitment of traders data tab, I want to show you something I found in regards to many calling it the culprit, and it's right here, JPY. You guys ready for this? So the Japanese yen was a fascinating tale this past week, and many people, myself included, speculate that the huge spike in the VIX was largely caused by the Bank of Japan and Japanese yen situation, which I'll explain it to you as simply as I can. Basically, the world borrows Japanese yens aggressively to go buy other things and invest in other things like, government bonds or perhaps real estate or stocks or crypto or gold. People borrow, and when I say people, what I'm talking about is hedge funds. Hedge funds, which manage a large amount of money, they borrow a lot of yen from the Bank of Japan. Why? Because the Bank of Japan offers very low interest rates. So if you go borrow from somewhere and they're going to charge you a high interest rate, it's not as attractive as if you go borrow from the Bank of Japan, where their interest rates are very, very low. That is until they started talking about rate hikes and the rest of the world is talking about rate cuts. That is where we get the unwind in the currency exchange of the dollar yen, the pound yen, the Aussie yen. Many people who were borrowing Japanese yen to go buy other currencies needed to reverse that course and actually sell their other currencies to buy back and cover their borrowed loans from the Bank of Japan or the Japanese yen. So we saw more evidence this past week of that unwind trade really taking place. And this is the culprit right here. So again, we speculated that all week long. If you're watching the channel, we talked about that a lot. But this commitment of traders data that came out really solidly tells us the story that happened last week. The Bank of Japan, again, mentioned wanting to hike their own, or they did hike their own rates. They talked about wanting to hike more. But then all of a sudden, the world sees a really poor jobs data point out of the US, and they get scared that, oh my gosh, we're going to go into a recession. Close out of your yen shorts immediately. And we can see that the balance of shorts to longs has drastically changed. But at one point, many of you guys who watch my videos regularly, you'll know that the Japanese yen was like one of the most shorted things on here. It is still shorted heavily by institutional money, but you can see the balance here has drastically come back in. And what I mean by that is we're no longer seeing like 90% short ratios on the Japanese yen ever since the unwind that occurred in the last, few weeks. So we saw in the latest filing though, the number of short contracts covered was dramatic. Now remember, a short squeeze is typically where, actually, let's just go do this. I'll show you a fun chart for this. So let's say we go JPY USD. So let's say we're just looking at the Japanese yen. A short squeeze is when the Japanese yen goes up, or any chart goes up dramatically, and it triggers people who were very short to have to cover their short. And what happens when you cover a short? It means you have to buy back the shorted position. You're borrowing or shorting something, you have to buy it back when you close. And that causes more buying, and that triggers more people's stops. That triggers more buying, so on and so forth. So what we may have seen in the Japanese yen was one big short squeeze, and that is made evident by the commitment of traders data. And this is why this tool is so powerful and so important to look at. This will uncover what's really going on at the big money level in the financial markets. So we saw a huge shift in the bullish favor, 14.1% swing on our net percentage change calculation. And you can see a ginormous covering of shorts, not just on the Japanese yen, but also another borrow currency, the Swiss franc. So we can see these two things saw massive covering or buying of short positions, which I think is really quite fascinating. And I think we've also really seen a lot of progress. Look at the balance has really come in on these things. Maybe not so much on the Swiss franc, still very heavily short, but perhaps the trade is behind us. This is my thought process with this and why I remain now very bullish on the market outlook. I don't see the economy crashing in the world. We got some nice healthy bounce back points this week. We saw jobless claims came in light, right? We talked about that. If we go over to the labor market, if you have the Edge Finder, definitely recommend keep an eye on the unemployment claims each week. They came in low. This was good news. And then, we also had the services PMI, another data point I look at very frequently. Services came in just on target, showing, okay, maybe the economy's not crashing, right? Maybe that jobs data point, which everybody got spooked about on last Friday, not this past Friday, but the one before it, maybe that was just a one-off bad number, and maybe things are just fine, and the market got absolutely terrified. You know what else I was looking at, guys? The AAII investor sentiment, where the average trader got super bearish compared to recent months, just at the worst possible time. And this happens so frequently. And this is why I preach over and over, you gotta be using market data because you can spot this stuff. Look at what market participants did during a crazy rally week, which is what this was. If you think this is anything other than an incredibly bullish week, then you've been hoodwinked. Because look what happened. We came into this week, Friday, Sunday, we see selling. Oh my gosh. Monday morning, what does retail do? Retail gets mega bearish right here. And then what happens? Boom. Beautiful up week. Strong bounce back, especially, guys, if we take a look at like high risk, high growth stuff. Look at the bounce back from the low here. If you bought SMH, which is semiconductors, companies like NVIDIA, AMD, Qualcomm, Broadcom, up 16% at one point almost this week. Incredible how people got so spooked out on Monday morning. And if you're one of them, I'm not, targeting you, but this is something to think about is you've got to keep an eye on the data, which shows huge swings into the bearish camp from retail traders right before the market ripped higher. It doesn't mean we're out of the woods, but you've got to keep an eye on this stuff. By the way, the tool that I'm using, this is called the Edge Finder. I mentioned it earlier. If you guys are interested in getting a copy of the Edge Finder and tracking our sentiment tools, as well as our economic data points and our top setups algorithm, I'll leave a link down below in the description and a promo code there for you. If you punch in that promo code, you get a nice discount off the tool. So again, the promo code is YTVIP, and the link to get this software is down below in the description. So punch in the code YTVIP. It will also be mentioned in the description at checkout, and you can get this tool for a really nice discount. So just apply that code, get it lower than it usually is just with that YouTube code. And then again, that's YTVIP. But again, if you're looking to get access to this tool, I'm telling you what, I've been saying this a lot recently in my videos, but I have not thought of a better time in my trading career to have this sort of data to rely on, to back up on when things get, kind of highly volatile. I found myself digging through the Edge Finder constantly, making sure I'm on the right track. And it has severely helped me during this time to say, nope, I'm not freaking out. Yes, the markets are selling off, but let's look at the data. And the data confirms where I'm at with the stock market, which is I'm still bullish on these things. And I didn't waver this week, and that ended up saving me a lot of money. So again, just something to think about. Get access to the Edge Finder, again, link in the description. Just wanted to show you guys that. Let me know your thoughts. Are we going to see more, a downside move in the market, or did we potentially bottom out? I lean towards the latter, but we could always be surprised. The markets are ever changing. So thanks for watching, guys.